Ever wondered how to decipher the financial health of a company? Today, we dive into the world of financial statements, your window into a business's story. Balance sheets, income statements, and cash flow reports hold the keys. They reveal where money comes from, where it goes, and what remains. Picture them as a financial fingerprint, unique to each enterprise. Let's unravel these numbers, unlocking a treasure trove of insights. By the end, you'll confidently navigate the financial landscape, armed with the knowledge to make informed decisions. Remember, financial statements are more than numbers, they tell a compelling tale of success or struggle in the business realm. Ever wondered what financial statements really are? These crucial documents serve as the report card for a business, revealing its financial health and performance. They unveil the story of money inflows, outflows, assets, and debts, guiding businesses of all sizes in monitoring progress and making informed choices. Financial statements are the essential compass navigating the financial landscape for companies. Why do financial statements matter? For investors, they are the gateway to evaluating potential returns on investment. Lenders rely on them to gauge creditworthiness and the company's ability to repay loans. Management uses financial statements to make strategic decisions, identify problems, and plan for the future. Regulators depend on them to ensure legal compliance and monitor business activities. In essence, financial statements serve as the compass guiding stakeholders through the complex terrain of business. Ever wondered how to truly understand a company's financial health? Enter the three main financial statements. The profit and loss statement reveals profitability trends, the balance sheet paints a snapshot of financial standing, and the cash flow statement tracks cash movements. Together, these documents form a comprehensive financial narrative. Profit and loss for trends, balance sheet for snapshot, cash flow for cash movements. Each statement offers a unique angle, culminating in a holistic view of the business's financial story. Profitability, financial position, cash flow, the trifecta of financial insight. In Chapter 2, we delve into the statement of profit and loss, also known as the income statement. This financial report reveals whether a company made a profit or incurred a loss within a specified period. Simply put, it's about subtracting expenses from revenue to determine the bottom line. Did the company make money or lose money? Think of it like checking your own monthly budget. Revenue represents sales earnings, while cost of goods sold covers direct expenses. Operating expenses reflect the costs of running the business. Ultimately, net profit reveals the final financial outcome. It's all about understanding if the company's earnings exceeded its expenditures. Just like balancing your own finances. Profit or loss, the statement of profit and loss holds the answer. Imagine this, ABC Company's financial snapshot for 2024 reveals a profit story worth telling. With $500,000 in sales revenue, the company turned a $50,000 net profit after accounting for all expenses. That's a 10% profit margin, showing solid financial health. Stakeholders can rejoice in knowing that ABC Company not only thrived this year but also secured a positive outlook for the future. Ever wonder how to capture a company's financial essence in a single snapshot? Enter the balance sheet. Unlike the dynamic profit and loss statement, this financial portrait freezes assets, liabilities, and equity in time, revealing a company's financial DNA. Picture this: assets equal liabilities plus equity, a delicate equilibrium that defines the balance sheet's essence. Every asset, from cash to property, finds its financial roots in either debts or owner investments. It's a delicate dance of financial harmony, a delicate balance that paints the true financial picture. Ever wondered how a company's financial health is depicted on paper? Think of a balance sheet as a snapshot of a business's financial standing at a given moment. On the left side lie the company's assets, what it owns, like cash, inventory, equipment, and buildings. Conversely, on the right side, we have liabilities and equity, representing what the company owes and how those resources are financed. Loans, accounts payable, wages payable fall under liabilities, while equity encompasses owners' investments, share capital, and retained earnings. It's crucial to note that the sum of assets must always match the combined total of liabilities and equity. This equilibrium is the cornerstone of a well-structured balance sheet, reflecting a company's financial equilibrium and stability. Takeaway: a balance sheet provides a clear picture of a company's assets, liabilities, and equity, serving as a vital tool in understanding its financial position. Ever wondered how a company's financial health is represented on paper? Take a look at ABC Company's balance sheet as of December 31, 2024. With assets totaling $300,000, it's clear that the company has a solid foundation. But how is this all funded? $100,000 in liabilities and $200,000 in equity paint the full picture. What's fascinating is how total assets perfectly match total liabilities plus equity, creating a balanced sheet. In a nutshell, a company's worth is a reflection of where its money comes from and how it's used. Balance is key in the financial world. Ever wondered how businesses differentiate between assets to be quickly liquidated and those providing long-term value? In Chapter 4, we delve into the distinction between current and non-current assets. Current assets, like cash, receivables, and inventory, are earmarked for conversion or use within a year. On the flip side, non-current assets such as property, equipment, and long-term investments offer value beyond the immediate horizon. These classifications are vital in understanding an organization's financial health and sustainability. Think of current assets as sprinters, swiftly turning into cash, while non-current assets are the marathon runners, steadily building long-term value. By recognizing the nature of each asset, businesses can strategically manage their resources for sustained growth and success. Ever wondered how companies categorize their debts? Classifying liabilities into short-term and long-term helps paint a clear financial picture. Current liabilities, like accounts payable and wages due within a year, keep things immediate. On the other hand, non-current liabilities, such as long-term loans and bonds payable, extend further into the future. This breakdown isn't just about semantics, it's crucial for evaluating a company's liquidity, its ability to meet financial obligations on time. When current assets can easily cover current liabilities, it's a positive sign of financial health. Think of it as balancing your checkbook, but on a larger scale. Understanding this distinction is key to grasping a company's financial standing. Ever wondered what makes up a company's equity components? Share capital is the initial investment made by shareholders to kickstart or expand the business. On the other hand, retained earnings are the profits accumulated and reinvested in the company rather than distributed as dividends. The formula for retained earnings is straightforward: beginning balance plus net profit minus dividends paid. This financial chapter showcases the core elements that shape a company's financial health, from its foundation to its growth. Think of it as the building blocks that lay the groundwork for a thriving business. Ever wondered where the money really goes in a business? Chapter 6 unveils the cash flow statement, a financial roadmap tracking the actual flow of cash in and out. While the profit and loss statement showcases profitability, this one reveals liquidity, essentially, if the company has enough cash to keep the lights on. It's a reality check. A company can look profitable on paper but hit cash flow roadblocks if customers delay payments or too much cash is tied up elsewhere. This statement is the truth teller, showing the real cash position in black and white. Cash is king in the business world. Ever wondered how a business juggles its cash flow? Let's break it down into 3 key types. Operating activities involve the daily cash exchanges, money in from customers, out to suppliers, and for salaries. Investing activities see cash flow into long-term assets like equipment or out from property sales. And financing activities bring in cash from owners and creditors through shares or loans, or out through dividends. Each activity plays a vital role in a company's financial health. Remember, operating activities keep the business running, investing activities help it grow, and financing activities ensure it stays afloat. Imagine this: you deliver a product in December, but the payment won't come until January. When should you record the revenue? The answer lies in the revenue recognition principle. Revenue is recognized when it's earned, not just when cash flows in. So, if you've delivered goods or services, the revenue belongs to that period, regardless of payment timing. Picture a consulting firm finishing a project on December 28, invoicing $10,000 due in 30 days. Even though the cash arrives in January, the revenue is logged in December since the service was provided. This principle is at the heart of accrual accounting, ensuring revenue matches the period it's earned. Remember, it's not about when the money lands, but when the work is done. Have you ever wondered how businesses decide when to recognize expenses? Expense recognition, guided by the matching principle, ensures that costs are recorded in the same period as the related revenue they helped generate. This means that even if cash is paid at a different time, expenses are aligned with the revenue they support. By doing this, the profit and loss statement accurately reflects the true profitability of a period. Imagine a puzzle coming together, each piece fitting perfectly to reveal the complete picture. This approach allows businesses to track their financial health effectively, ensuring a clear understanding of costs and revenues. Ever wondered how financial statements connect? Picture them as pieces of a puzzle forming a complete financial story. Net profit flows into retained earnings, while the cash balance on the balance sheet matches the cash flow statement's ending cash. Changes in balance sheet accounts shed light on cash flow movements. These interconnected statements, balance sheet, cash flow statement, and profit and loss, work together seamlessly to reveal a company's financial health. In essence, they are the vital components that paint a comprehensive picture of an organization's financial standing and performance. Ever wonder how to dissect financial statements like a pro? Let's dive into the numbers for ABC Company. Their revenue surpasses the industry average, a clear sign of robust sales. A healthy profit margin reflects efficient operations at work. Despite fewer total assets compared to the average, the company's higher revenue showcases resource efficiency. These factors combined paint a picture of financial strength and operational prowess. In a nutshell, ABC Company's numbers speak volumes about their success in the market. Ever wonder how to gauge a company's financial health at a glance? Key ratios are your window into the numbers game. Profit margin, the sweet spot where revenue meets profit. Current ratio, the balance between assets and liabilities for short-term stability. Debt to equity, the tightrope act of leveraging risk. These ratios speak volumes without saying a word. So, are you ready to decode the language of finance? In the world of finance, your toolkit consists of 3 essential statements: the profit and loss, the balance sheet, and the cash flow. The profit and loss answers the question, did we make money? The balance sheet reveals what a company owns and owes, while the cash flow shows where cash came from and went. These statements are interconnected, providing a complete financial story. By understanding and analyzing them, you gain insight into a business's health, trends, and can make informed decisions. Remember, financial statements are tools for storytelling, showcasing a business's performance, position, and potential. Mastering these statements empowers you to decode any business's financial narrative effectively.